The market is about to get a lot louder, and most people still do not understand why. They think volatility comes from wars, rate cuts, earnings misses, or some politician saying something stupid at the wrong hour. Fine, those things matter. But some of the biggest market shifts begin somewhere much less exciting. In the rule book, that is where this one begins. A rule has changed. It sounds technical, it sounds narrow. It even sounds like something only day traders should care about. That is exactly why ordinary investors are underestimating it. They hear the phrase pattern day trading and assume this is somebody else's game. It is not, because once you change the rules around speculation, you do not just change one corner of the market. You change the flow of money, the speed of turnover, the pressure on volatility, and the amount of gambling energy that can suddenly spill into sectors that were already unstable enough. That matters to everybody. It matters if you own growth stocks. It matters if you own biotech. It matters if you own crypto, linked equities. It matters if you own broad index funds. It matters because a market with more speculative access becomes a market that can move further, faster, and more violently than before. That is the first rule. When you reduce friction for speculation, you do not just help the speculator. You change the environment for every investor standing in the same market. Now, let me tell you what changed for years. There was a barrier in place for pattern day trading. If you wanted to buy and sell the same stock repeatedly in the same day inside a margin account, the system pushed back once you crossed the threshold. Often enough, in plain terms, you were not supposed to behave like a full-time day trader unless you had at least $25,000 in the account. That threshold acted as a filter, not a perfect one. But a filter, it kept a certain amount of pure impulse, small account gambling, and repeated same-day speculation from flooding all the way through the brokerage system. Now that barrier is gone in the source material, and what replaces it is much looser access. Instead of needing $25,000 to keep engaging in that style of trading, a margin account with far less capital can now start behaving much more aggressively. In the source transcript, the practical threshold falls toward the margin account minimum level, around $2,000. That means a great many more people can begin trading the same kinds of short-term bursts that used to be gated behind a larger capital requirement. That is not a small adjustment. That is a cultural change in market structure, because once you lower the gate, you do not just let in disciplined professionals who were unfairly excluded. You also let in a larger wave of people who want intensity, quick outcomes, emotional payoff, and the feeling of constant action. And markets are always happy to take money from people who confuse action with skill. That is the second rule. Lowering the cost of participation does not lower the cost of mistakes. It simply allows more people to make them. Now let me be fair, I understand the argument on the other side. The old threshold looked paternalistic. It looked like a club rule. If someone had $24,000, the system said no. If he had $25,000, suddenly the system said yes. Now you may behave the same way. That is not a very elegant line. So I understand why brokerages wanted it gone. I understand why active traders wanted more freedom. I understand why parts of the market sold this as democratization, but democracy in finance and protection in finance are not the same thing. A casino is democratic too. That does not mean it is healthy. And that is where I think the public gets fooled. They hear access and think opportunity. Institutions hear access and think volume. Those are very different interpretations. The retail investor hears, now I can trade more. The brokerage hears, now you can transact more. And every extra transaction has a very obvious beneficiary, the house. That is why I want to say something plainly. This rule change is probably better for brokerages than it is for traders. Much better. Because when the flood starts, the broker does not need every trader to win. He only needs the activity to happen. Activity is revenue. Activity is engagement. Activity is deposits. Activity is spread capture, margin use, options, flow, payment for order flow economics, and all the other little toll booths that turn emotional trading into very real business results for the firm sitting closest to the traffic. That is the third rule in speculative market regimes. The most dependable winner is often not the trader. It is the platform collecting the toll. Now think about what kinds of stocks and sectors are likely to feel this first. Not every part of the market gets hit the same way. If a sector is easy to game, easy to narrate, easy to push emotionally, or already prone to sharp reactions, it becomes a natural playground for this new wave of short-term capital. Biotech is an obvious example. Why? Because biotech already trades in bursts around FDA decisions, trial data approvals, rejections, and rumor, it is a perfect emotional setup. The stock can be dead quiet and then suddenly explosive on one piece of news. That sort of structure attracts exactly the kind of speculative energy that looser day. Trading rules amplify. People do not want to own the company for 5 years. They want to guess the next jump. Pharmaceutical event names behave similarly. Pre-profit technology names too, especially the fast-moving edges, AI-adjacent names, bleeding, edge hardware names, electric vehicle tool chains, and all the businesses whose valuations are already stretched around hope rather than durable current earnings. These names naturally move in waves. They rip on announcement, get shorted, reverse, squeeze, unwind, repeat, add more undercapitalized, hyperactive trading energy to that environment. And you are not creating stability. You are turning up the volume on a machine that was already loud. Then there are the fully gamified corners of the market, crypto, linked equities, crypto ETFs, meme stocks, anything that already lives halfway between finance and entertainment. These names do not need much encouragement. They already trade on community emotion, social media bursts, and the excitement of being in the story. Looser intraday access does not civilize that energy. It multiplies it that matters, even if you do not personally touch those names, because volatility tends to spread, not evenly, but it spreads once speculative money begins looking for rapid outcomes. It does not politely stay in one bucket. It moves. And as it moves, it influences options, volume, dealer hedging, short squeezes, liquidity behavior, and price discovery more broadly. That is how the mood of the whole market can shift, even if the rule was introduced under the narrow label of day trading. Now, in the source material, the specific rule described is FINRA Rule 4210, the pattern day trading framework that used to flag repeated same-day buy and sell activity and effectively box traders out if they did not meet the capital requirement. With that structure abolished in the source narrative, anybody with a margin account and a small enough threshold of capital can begin acting far more aggressively. That changes who gets to play. It also changes how brokerages manage risk. And this part matters more than people realize. The burden of regulation shifts away from the old hard line and toward broker algorithms. So now the broker has more discretion to watch how you trade, decide how risky you look, and determine whether you trade on straight cash, limited margin, or a more permissive footing using their capital. That sounds efficient, maybe it is. But it also means brokerages are not merely passive platforms anymore. They become dynamic risk allocators on the other side of a much more speculative retail environment that gives them even more control. And usually the institution closest to the control point has the advantage. Now let us come to the uncomfortable part. This change may be great for business and terrible for many participants. The source transcript cites a devastating statistic. 96% of pattern day traders lose their shirt. I believe that number emotionally even before I believe it mathematically, because the logic behind it is so obvious. Pattern day trading is one of the closest legal cousins to gambling that the securities world offers. It tempts people with speed, repetition, and the illusion that activity is mastery. Some will win. Of course, there are always a few winners. There are always a few people skillful enough or lucky enough to survive longer than the average. But the structure as a whole remains what it is, a system in which the median participant pays heavily for an education he thought he was getting for free. That does not stop the wave. It feeds it because people do not learn from statistics in advance. They learn by losing in practice. That is the fourth rule. The most expensive education in markets is the one people insist on paying for personally, even after the statistics already explain the outcome. Now, this is why I think the true beneficiaries of this rule change are not the traders being seduced by freedom. They are the businesses closest to the flow. Let us begin with the most obvious name, Robinhood. If you wanted one company that symbolizes the gamification of finance, it is hard to pick a cleaner example. Robinhood did not invent speculative impulse, but it wrapped it in a beautifully frictionless interface and sold the user the feeling that markets were accessible, social, quick, and fun. That matters. Because when a structure like the pattern day trading restriction gets removed, the platform already optimized for ease, speed, notifications, and emotional engagement gets first call on the new wave of interest. In the source material, Robinhood is presented as the company that started much of this democratization theme, and whether you love or hate that framing, the economic logic is undeniable. If more small traders want to enter the game, the app already designed for exactly that kind of behavior stands to gain. More accounts, more trades, more engagement, more options flow, more margin activity, and possibly over time, more deposits. The stock had already shown meaningful movement in the source transcript with a strong 30-day bounce, but still room below prior highs. That is not the point by itself. The point is that the market already understands Robinhood sits directly in front of this behavioral shift, but Robinhood is not alone. Webull is another major candidate. What makes Webull interesting in the source narrative is not just that it benefits from the same broad trend, it is that it appears to have been ready first. When rules change, readiness matters. If a company helped push for the change-adjusted systems early and rolled out the new functionality faster than rivals, that company may enjoy a first-mover window where speculative traders shift behavior before the rest of the field catches up. That is important because in trading businesses, flow can be habit-forming. If a trader finds a platform that gives him the freedom and tools he wants, he may stay. Webull also sits in a slightly more socialized part of the retail ecosystem. Robinhood is gamified. Webull leans more toward a hybrid of social proof and trading utility. Both matter, both can be sticky. And if one of them moves faster at the exact moment, the new rules matter, the early advantage can translate into user growth, activity growth, and the kind of performance numbers markets like to reward. Now we come to a different category, interactive brokers. This is not the same story. Interactive brokers was not built primarily for the novice who wants a confetti cannon in his pocket. It was built with more serious active traders in mind. The tools are more technical. The environment is more geared toward actual market work rather than pure retail stimulation. And that creates an interesting dynamic. The speculative novice may begin his life in the market on Robinhood or Webull. But the trader who wants to become more serious, who wants better tools, better execution logic, more professional structure, may eventually migrate toward the platform designed for the activity itself. That is why interactive brokers matters. It may not capture the very first emotional wave in the same way, but it may benefit from the second step, the escalation, the trader who wants more. The trader who decides this is not a weekend curiosity, but a serious operating environment that is valuable flow too. And because the company already understands the mechanics of active trading, its guidance, user numbers, and account activity metrics can become a useful barometer for whether the rule change is actually changing behavior or just creating noise. Then there is Charles Schwab. This is a different sort of play altogether. If Robinhood is the pure, play gamified retail name and interactive brokers is the technical active trader platform, Schwab is the diversified institution with serious infrastructure and broad business lines well beyond this single rule change that makes it less theatrical. And for many investors, that is a good thing. Schwab has tools designed for serious traders. Thinkorswim matters here. That platform did not begin life trying to charm novices with simplicity. It was built for people who actually wanted tools. So if day trading access expands and active retail behavior grows, Schwab can participate in that trend while also benefiting from the much broader economics of being a huge financial services company. This matters because if the rule change ends up being meaningful, Schwab can win from more activity and more deposits. And if the rule change later proves too chaotic, too politically controversial, or eventually subject to reversal, Schwab is probably less exposed than the more concentrated names. That matters to me. Diversification inside a brokerage business is still a form of safety. And finally, there is the one behind the curtain, CBOE Global Markets. This is the toll booth, the picks and shovels player, the one that benefits from the traffic regardless of which brokerage app gets the social media excitement. When speculative activity rises, options activity rises. When options activity rises, volume flows through the market structure, and CBOE sits right in the architecture of that structure. This is what I mean when I say the best money is often made one layer behind the obvious story. Everyone gets emotional about the broker in their pocket. Far fewer people ask who collects from the increase in options behavior, derivatives usage, and volatility. Linked market flow regardless of which front-end app the customer happens to love this month. That is the fifth rule. When speculation increases, the steadiest beneficiary is often not the brand visible to the gambler, but the infrastructure invisible behind the bet. Now, I want to step back and make sure the full picture is clear. This rule change does three things at once. First, it lowers the barrier to repeated speculative intraday behavior. Second, it injects more volatility into the sectors already most vulnerable to emotional trading. Third, it transfers a great deal of economic opportunity to the platforms, brokers, and exchanges closest to the resulting flow. That is why I think every investor should care. Even the patient one, even the long-term one. Because once market microstructure shifts, you are still living in the market it creates, whether you choose to participate in the day, trading frenzy or not. The biotech you own may now move more violently around catalysts. The AI stock in your retirement account may become even more of a battleground between momentum chasers and short sellers. The crypto-linked names may turn from messy to theatrical. The options market may absorb more retail heat, and the broad index itself may begin reflecting more of that churn than investors were used to. None of this means the market stops working. It means the emotional temperature rises. And when emotional temperature rises, the disciplined investor has two jobs: do not become the noise and understand who gets paid from the noise. That is really the heart of the lesson. Retail traders may see this rule as liberation. Brokerages may see it as a windfall. The market itself may see it as a volatility injection. And the long-term investor should see it as a reminder: rules matter, incentives matter. And the person closest to the transaction often benefits more reliably than the person dreaming of the trade. Now, does that mean you rush out and buy every brokerage stock mentioned in the source transcript? Of course not. That would be just another version of the same mindless behavior this whole environment encourages. You still have to respect valuation, you still have to respect business quality. You still have to ask which firms are already pricing in much of the good news and which are not. You still need to separate concentrated, pure play exposure from diversified institutional exposure. You still need to understand that even the right narrative can produce the wrong investment if the price is foolish enough. But the direction is clear. More speculative access likely means more transaction flow. More transaction flow likely means more revenue for brokerage and exchange infrastructure. And more volatility likely means an environment where ordinary investors need to be even more disciplined than before if they want to avoid getting sliced up by a market increasingly designed to reward activity over patience. That is why I do not think this is just a day trading story. It is a market reset story. Maybe not the biggest reset in 25 years in the dramatic way headlines love to say it, but certainly the kind of structural shift that can change behavior far beyond the small legal language where it began. And structural shifts are always worth respecting, because by the time the crowd emotionally understands what changed, the institutions closest to the new flow have usually already been positioned for quite a while. That is how markets work, quietly first, then very loudly. So if you ask me what matters most here, it is not whether this rule makes day trading more fun. I do not care whether it is fun. I care whether it changes who wins, and I think it does. The brokerage collects, the exchange collects, the options pipes collect, the trader, more often than not, pays tuition. That is the whole machine in one sentence, which means the real question for any serious investor is not, should I start day trading now that the gate is open? The real question is, who benefits from the gate being opened? That is the question adults ask. And in markets, adults usually do better than the people still confusing access with advantage.